Hello, this is my first attempt at a little bit of a video market update. Talking with some of you, you've said you'd rather see a video or listen to a video with my voice rather than reading a PDF document with a little bit of an update. So this past week, I had the opportunity to be in Ottawa for conferences and training. Every year this week is my fine-tuning week that I use to determine what 2023 is going to look like. We look at investment strategy, both personal, corporate, taxation, and estate tax as well, and also cash flow strategy and planning. While in Ottawa, some very important current events occurred, which were timely as I was surrounded by industry professionals and experts. I was able to have many long, great conversations with them to get a better understanding of what's happening and what the future is looking like. Going back to the beginning of the month, the Bank of Canada raised interest rates to 3.25% to help combat inflation. Raising interest rates is a terrible way to combat inflation, but this is the card that the central banks have chosen to play. In Canada, we import a significant amount of products and services from the US. The US dollar has reached an all-time high compared to other global currencies, including Canadian. This means that as we import things from the US, it costs us more, and that increases inflation here in Canada because of the increased cost. When a central bank increases their interest rates, the currency value increases. So that's why Canada anyway, has decided to increase our interest rates to combat that inflation of imports coming in. Canada's inflation is going down. It's sitting around a 7% mark. Normal inflation target is usually 1 to 3%, but they've come to terms that we're not going to get there for some time, and they still set a target for the higher band of about 3% or so. So this week, the US raised interest rates as well to 3.25%, so they're now the same as Canada. Because their inflation wasn't 7%, it was 8.26. So Canada's inflation sits at 7% and the US at 8.26%. But the US dollar is valued higher than the Canadian dollar and higher than it has been historically. That means that the US should be able to import a significant amount of goods and services and bring inflation down. But on the flip side of that, less nations will be able to afford US products and will cause the demand to be lower, which could cause the US to sell less and therefore stop producing as much. Less production means less growth for the US economy, which results in less spending and the potential for a soft recession in the US. At any point in time, a nation somewhere in the world is in recession. It's a natural cycle of the economy and is the result of growth or expansion followed by contraction. So what goes up has to come down at some point. The US is the largest economy in the world, so when it occurs in the US, the rest of the world feels the pain. There are two types of recession, big R and little r recessions. Big R is a long extended period of time, such as a minimum of 12 months and can go as long as 3 years. A little r is short-lived, and this is what we are expecting because it is a self-inflicted recession. It likely will not extend into Canada as our oil and gas are sold in US dollars, which are at an all-time high, as I'd mentioned. So a little recession usually is a smaller, within a year, things are going to settle back down and get into some normal terms. So oil the other day did drop below $80 a barrel, but this is in US dollars. So when you convert that to Canadian, it's still $109 a barrel, and our energy producers are quite happy with that. Japan, China, Saudi Arabia, and Switzerland are all under 3.5% for inflation rates. These countries did not print the kind of money other countries printed during COVID. They were far more fiscally responsible. No one knew how much money the US and other countries, such as Canada, printed in 2020 and 2021, but clearly it was significantly more than Switzerland and those other countries, and now they're feeling the pains that come with it. The markets are dramatic, and there's no other word to describe it. This is especially so in a bear market. Bear markets are when the price declines over a prolonged period and of 20% or more. So they've dropped to 20% for a prolonged period, usually 3 to 6 months. This is called a bear market. The opposite is a bull market. So we're talking about animals. Bear hibernating mentality. I'm not quite exactly certain why they call it a bear market, but a bull, of course, is aggressive. It's forward. It's charging. It's just some fun that Wall Street likes to have with terming these events. So a short-lived recession in the U.S. will result in inflation leveling out for its citizens. Once this is achieved, then they can start to lower interest rates, which will provide relief for the economy, and it can reset to a more normal, efficient level. Just half an hour ago, I was watching an article on Bloomberg TV, and they were actually showing their data points and plots already in place for interest rate drops in 2023. Last week, we were thinking that might not happen until 2024, but to the extent in which things are at right now, they're even saying 2023 we could see some interest rate drops, which would be great. It'd be good for everybody. The reason why portfolios around the world are feeling pain is because of the fallout in the bond market. Very rarely do bond markets drop along with stock markets. This is because of all the money Canada and the US printed, which has resulted in inflation, which is causing us to increase interest rates, which adversely impacts bonds. Usually, a bond is a safety net against equities, but when it's down and inflation's high and interest rates are rising, stocks just don't perform great. We're seeing this in tandem together. Interest rates aggressively increasing put publicly traded companies' profits and growth in question, thus causing a drop in the stock market. But here are some strategies for moving forward. If you're trying to grow your portfolio, it may be a good year to spend less and invest more, as everything is at a discount. Every stock we buy, every bond even too, everything is at a discount. If you're withdrawing from your portfolio, continue to do so, but take minimums from your RIF and your LIF and increase withdrawals from your non-registered accounts, particularly holdings that are at a loss, such as bonds. By doing this, you claim a loss and it goes as a tax break against your income. So this is a year which will have a little bit less of a tax bill. Seek dividends, as the cost to borrow is high, and so companies would rather utilize the sale of stocks and issue dividends rather than being tied into a high interest rate loan from a bank. Dividends, they can control how much is being paid out. They can increase it, they can decrease it. You can't increase or decrease your interest rates with a bank. The bond markets are attractive again, as new bond issues will start to have higher coupon or interest rates associated with them. Interest rates are up, so new issues of bonds will have a higher interest rate or coupon to them. Europe is attractive again, but I want to see what happens this winter first, as Northern Europe, they're going to have an issue with energy, especially as Ukraine and Russia continues to, the battle between them continues to go on, and we don't see an end in sight. Southern Europe, different kind of story, might be a better place to find some opportunity. China and other exporting Asian countries are well positioned, but they historically perform poorly when the US dollar is high. As the US dollar drops over the next year, Asia will be a strong performer. Gold, because everybody asks me about gold, not while interest rates are rising and the US dollar is strong. That just isn't a good environment for gold. Crypto, if you want to go there, crypto is doing what it's not supposed to be doing. It's supposed to be, in theory, a hedge against equities and everything else. However, it is plummeting faster than the equity markets. So that's crypto. It's new, it's untested. It ultimately is sold on a market, which is a free market. It all depends on who's buying and selling. The point of the government's strategy to lower inflation is to try and stop spending, as everything costs more because of inflation. It costs more because savings are down, and it costs more because interest rates are high. So taking out loans are less appealing, which we see in mortgage rates right now. They're over 5%. They're going to continue to go up as well too. We could see 5.5%, hopefully not 6%. And even bank prime is at 5.45%. So anyone that has a line of credit that's floating or has a balance on that, they're feeling the pain to this. GICs and cash savings, they look pretty good at that high 4% or low 5%, but it's still below inflation. It's a guaranteed loss. I recommend these only for short-term cash needs or large purchases. So it's not for income, growth, or a safe haven purpose. Now, I don't want anyone to think that this video is by all means a replacement for having a meeting with me. This is just a good way to give a little bit of an update as to what's happening and to get that information out faster. Book a meeting with me if you have concerns or questions. Your financial plan is key. It is the number one thing. We will take that financial plan, we'll upload the new balances within your investment accounts, and we'll run the strategy. We'll run the age till age 90, how cash flows look. This will be a short-lived blip. It's not a natural recession. It's a self-imposed from the banks. There will be recessions. It's just going to happen. But this one is a little R, as we kind of mentioned, and it can be remedied very, very quickly by lowering interest rates and stabilizing the economy that way. But I want to get this out in a timely manner because I want everyone to be sleeping well at night. I want them to continue to enjoy life. There's so much going on, you don't have to worry about your finances. Let me help with that. Let me take that burden off of you. Mental health is a big, big part of our lives. And I want to make sure you're sleeping and you're just not running constantly in your head about markets and other things. Let us do that job. We're far better and far more experienced at it, and we understand the cycles and we understand the timing of things. So again, this is not a substitution for a meeting. If you have concerns or worries, come see me. Give me a call. My door is always open. You all have my cell phone number. And if you don't, it's 403-977-7636. This is YouTube, so you can rewind to see that. It's 403-977-7636. That's what I have for you today. Hope everyone's doing well, and I'll talk to you soon.